cases, we have exercises, and I will present you my program. But we will try to do this as much as interactive as it can be, because unfortunately it's only online. Okay, so therefore there's different ways how you can participate. I have a second screen here, so I see what's going on. You can either write messages in the chat. Okay, so if you have questions, type them in the chat, and then I will see and answer them. You can also, in big blue here, raise your hand, and then I will give you the word. Or you can also just turn on your mic and interrupt me when you have your question. Okay, so please use any of those possibilities to participate and interrupt me and ask questions. So not only questions going beyond that, but obviously also if I give explanations and you do not or you did not really understand the question, or you have a follow-up question on what I said, something that I did not talk about. So do not hesitate to interrupt me and ask as many questions as you have, please. Yeah? Okay, so before I start and I share my screen and we get going with the program, I have a first introductory question for all of you. So I will send you a poll, okay? And the question in the poll is, who of you did already study or work in accounting as of today? So actually before we start the class, okay? So I send you the poll. Could you please answer with yes, no, please? There we go. Okay, there are no more. There are no more answers coming up. So we see here from the 20 participants, well, 2/3 do have experience, 1/3 does not have experience. Okay, so I ask you this question to see how fast we can proceed, and also how detailed I may discuss certain points. So in particular, for the 6 people who did not previously study accounting or worked in accounting, it is very important to catch up with the basics of accounting. So we'll do this a little bit here today, but it may be necessary that you go beyond what we do here today. So by looking at my slides that you have also on Blackboard, see here, okay. So here I have some resources, and the first one is the corporate finance textbook, which you have. Okay, the Burke DeMaso. There are several chapters in accounting, especially the chapter 2 is on basics of the balance sheet, income statement, and so on. So in particular, people not yet familiar with accounting should read and work through the chapter number 2, whereas 28 and 30 are more advanced chapters. You also have this online textbook that you see here, which is online, okay? And you have a lot of on managerial accounting, but also financial accounting. So you have written pages here, but there are also videos, and the same thing in particular, people who do not have an advanced knowledge in accounting should catch up here with the introductory parts of this textbook. No? And then here's some videos on, you have them on YouTube or on CPD Box. This is more advanced content. Okay, so we'll discuss the content here in our class. You see that we will talk about IFRS, of course, International Financial Reporting Standards. And here are the different standards that we will discuss. And on most of these and some others, actually, you have videos that you can check on the CPD Box or on YouTube. It's the same thing. You find the same videos on YouTube. Okay, other than that, we'll go through the program here with my PowerPoints. Okay, you ask as many questions as you like, please. And once in a while, we will interrupt this by doing cases, exercise in cases. You have some exercises already on your platform. And we also have a look in real financial statements, in particular, the financial statements of Air France. The financial report is also available on Canvas and posted there. Okay. And there will be, to get the credit, the grade for this class, there will be an exam. I think it is already scheduled, but we have to confirm this with administration. And it's a 90-minute exam. Same thing, covering mostly cases, some real life excerpts of financial statements, and maybe one or two short theoretical questions. And I posted the exam from last year also on Canvas, so you get a rough idea what the exam will look like. Obviously, the exercises will not be the same this year, but the structure of the exam will be similar to the one of last year. Okay, are we good so far? No questions at this point? If not, then we will get started. Okay, so first we have a short reminder on accounting. Okay, and then we have those 4 parts: general introduction into IFRS, what does it actually mean, and what is the main content of IFRS financial statements. More in detail, how to prepare consolidated and group financial statements in the second part, consolidation. Then we switch over from this to accounting for financial instruments on the asset side, on the liability side, and equity of companies. And part 4 talks about impairment testing for non-current assets and accounting for provisions. So these are the main areas. But again, as I said, if you have questions outside of this area, it's no problem. Please ask them, and I hope I can answer them. Okay, a reminder of accounting. Okay, what do we do in accounting? Well, actually, we identify, we write up and communicate information. So companies do their business every day. They buy raw materials, they produce products, they sell the products, they pay money to their suppliers, they receive money from their clients, they interact with the authorities and pay taxes, etc. And in accounting, what we do is we take all these transactions and we write them up, obviously in the form of numbers, because accounting is a quantitative discipline. So we write up all those numbers, which means that doing my accounting every day generates databases that is full of accounting information, full of accounting numbers. And when I build a databases, what I do later, obviously, is I will extract information from this databases. And that raises this extraction process, so to speak, raises different questions, because we do those extractions, obviously, because some people, well, the people who do the extractions of the databases, they want to make decisions. Okay, so they use the information to make decisions. But that raises different questions. So, for example, the first one is, well, who are the users of accounting data? So I return this question to you. So who are potential users of accounting information? Financial statements that we have, or even managerial accounting. It's the same thing. Managerial accounting, also part of the accounting system. So who may be users of all this information? Any idea? Just write it or just turn on your mic. Either way. So here we have a first answer. Business owners, investors, regulators, tax authorities. Yes, very good. So we have different populations. And obviously we could add to this creditors, for example, so banks or other people that gave loans to the company, including our suppliers, for example. Why do you think a supplier is a creditor of a company? You know, we understand that the bank is a creditor of a company. The bank lends us money, a loan. The bank gives us a loan. We need to reimburse the loan. We need to pay interest on the loan. Therefore, naturally, banks are creditors and as such are interested in checking the financial statements of the company. But we can also consider suppliers as creditors. So why do you think suppliers are creditors? Since they do not really lend us money. But why are suppliers many times, not all the time, but many times, why are suppliers creditors? Which means, in other words, they are in the same situation as banks, basically. Well, we can put them in the same boat. Some people are writing. Okay. Need to get to the messages. Suppliers. Okay, so on the one hand, Tuido, so I'm sorry if I mispronounce your names. So for suppliers, they assess credibility, okay, the company's ability to make payment for goods. And why? Well, that's Dong Pan who gives the answer, because suppliers allow their clients to defer payments. Obviously, we receive products and services from our supplier, but in a B2C, a B2B setup, obviously, we pay our supplier only 1, 2, 3, 6 months later. And during that time frame, our supplier is our creditor, of course. Okay, so we have different user of the accounting data. Very good. But now we have this big databases with all the information in it, and we have different types of users. Therefore, the next question is, well, which information is relevant for the different users? And maybe the different users do not have the same information needs. So if we take two main users of financial statements, that is the investors, so in other words, shareholders of the company, and creditors, banks and other forms of creditors. Investors and creditors maybe do not have the same information needs. For example, when you think about a shareholder or an investor, what do you think would be the first accounting number, the first financial information that a shareholder would look up in the financial statement of a company? What is the most important accounting information for a shareholder? What do you think? Any ideas? So I'm a shareholder of Air France, the French airline company. And now I received the newest report of Air France. What do you think, as a shareholder, would be the very first number I would check in the new report? Or what type of information? The profit, yes, Dongpan, that is correct. The profit would be the first number. And why? why would they check the profit first and not, I don't know, total equity or the assets of the company? Why is profit probably the most important number for an investor, a shareholder? Well, Dongfan says because that's the purpose of investing, making money. All right. And Chung Tran answers cash flows could also be an important information. So first, regarding profit, and it's the purpose of investing. Indeed, the shareholder buys shares because he wants to make money. And obviously, as a shareholder, there's two ways how to make money. The first one is increasing share prices if the shares are listed on the stock exchange. If they are not listed, the way to make money is that I receive dividends. And dividends are based on profits. And the profits we are talking about here are the accounting profits. Okay, so in many countries, not everywhere, but in many, we could say in most countries, dividend payments are legally linked to accounting profits. So in other words, if the accounting profit is 10 million, then the company cannot pay more dividends than 10 million. Well, I'm simplifying here, it's a little bit more complicated, but roughly that's the idea. So therefore, shareholders would check profits first because the higher the profit, the higher the potential dividend payments could be that they receive. Now, Chung Tran says that cash flows could also be an important information, which is actually correct, because you can argue that, okay, in order to pay dividends, the company needs money. So therefore, I would need to check if there is enough cash to pay dividends. However, I would consider this information on cash flows as secondary compared to the profit information. Because if you have profit but no cash flow, well, you still cannot pay dividends. So therefore, profit is here more important. And even if I do not have cash flow right away or cash right away to pay dividends, there are actually solutions that I can find in the short run. For example, in the current situation, we have many companies who pay dividends, and actually to do so, they raise debt. So to simplify, they take on a bank loan in order to be able to pay dividends. So that's one possibility. Obviously, maybe not the optimal one to solve my cash problem. But profit certainly is a very important, or the most important accounting number for shareholders. Now let's talk about creditors, banks or suppliers or other people that lend money to the company. So not shareholders, but banks. So you are a bank, you made a loan in the past to a client company, and now you receive the financial statements of your client company. What do you think as a bank would be the most important accounting information? What do creditors check first when they check the financial statements of a client company? What do you think? Most important accounting information for a bank or any other creditor? Okay, so here we have the debt equity ratio. All right, that's very good. We have, secondly, the answer, the cash flow. We have liquidity of the business, such as debt equity, liquidity. Okay, all these answers are good. So when we talk about the debt equity ratio, all right, that tells us something about the solvency of the company. So the overall debt level of the company, and obviously as a creditor, I would be rather concerned if the debt level, the debt equity ratio is very high. Well, very high compared to competitors, very high compared to the historic average of the industry, etc. Okay, so debt equity ratio tells us something about the debt level and the leverage level of a company. Similarly to the last proposal here, the debt service coverage ratio, it's the same thing. If my debt service is very high, well, that means I may get in trouble and I may not be able to reimburse my debt. So this is a solvency issue. When we say solvency, we speak about the long-term possibility of a company to reimburse its debt. So long-term meaning over the next 3, 5, 10 years. And since I'm a bank and I gave you a loan and maybe my loan runs over 10 years, then obviously I want to know if over the 10 years you will survive and you will be able to reimburse. A second point that is raised here in the chat is, or that is mentioned, is liquidity. So yes, indeed, liquidity is also very important for creditors. Liquidity, on the other hand, is the short-term capacity of a company to pay its bills. So liquidity, we're not talking about the next 5 or 10 years. We're talking about next week or the next month. So will I be able next week to pay my bills? Because if a bill is due, I need to pay it. So this is liquidity. However, liquidity is not measured with the debt equity ratio. Dongfan. Okay, so debt equity ratio is long term. Liquidity, we need to use other ratios. For example, we have the quick ratio or the current ratio, that is current assets divided by current liabilities, for example. That would be a liquidity ratio. But anyway, all your comments are correct. Creditors are more interested in liquidity and solvency. And since none of you mentioned profit, that means, well, apparently, according to you, and maybe I agree, according to you, creditors, banks, and so on, are not interested in the profitability of the company. What do you think about this? Do banks and creditors care about profits of the company in the same way as shareholders? We said shareholders, the most important information, but how about creditors? Do banks care about the profits of the client company? I don't know. Yes, no, maybe. So, for example, Tuidung Nguyen, you says, yes, banks do care. Okay, but apparently it is not the primary concern of the bank, because we said before, it's more like the debt level, the debt equity ratio, solvency, liquidity, and all that. That is important. We did not mention, you didn't, and I didn't, we did not mention profitability. So we can say, yes, banks do care about the profitability, but it is not the primary concern. In other words, there is no immediate negative consequence for a bank if a company makes a loss. Okay, there will be an immediate negative consequence for the shareholder if the company makes a loss, because no profits, no dividends, okay, but not for the bank. As long as the company can continue to pay its debt and payments are related to cash, not to profit, then the bank is fine. Obviously, the bank will always prefer that the client company is in good health than in bad health. And good health is measured, or one way to measure it and to see this in an easy way is profits. So therefore, the bank will sleep better at night if the company makes profits all the time. But even if the company makes losses, it's not as big a deal as long as I think they can still continue to service their debt. Okay. So that means, and going back here to the second point, that means we have different users of the accounting information, but what is relevant for them is not necessarily the same. And as we said, shareholders care more about profits. Creditors care more about the debt level, cash level, liquidity, solvency, and things like that. And that means, okay, I have my databases with the accounting information. I make the extractions. But before making the extractions and the way how I do them, I need to think for whom the information is destined. Do I do the extraction for shareholders or do I do the extraction for creditors? And if the answer is different, well, the type of information, the way it is prepared, the way it is presented, etc., the way it is calculated may be different. because those two populations, shareholders, creditors, do not have the same interest in accounting information. Since accounting is a regulated area, in accounting we cannot do whatever we want. We have to follow laws and regulations. Actually, it's the regulator of each country. So either the government or some specific accounting regulator. It's the regulator of accounting who has to decide for each country which is the preferred group of readers, of decision makers that I'm aiming at. What is my target audience? Are we talking about shareholders or are we talking about creditors? So in continental Europe, okay, and also in Vietnam and also other countries, the main target audience of the accounting regulation are creditors, in particular banks. Why? Well, because the economies in continental European countries, France, Germany, Italy, Spain, and so on, is largely driven by bank loans, not by financial markets. And it's the same situation in Vietnam. Okay, therefore, Vietnamese accounting is largely driven to please creditors because those are the main readers of financial statements, the most important ones. In many Anglo-Saxon countries, so the UK, the US, Australia, New Zealand, and other countries, the main target audience of financial statements are shareholders. Okay. Therefore, the accounting regulation will be made in a way that pleases shareholders. So it will be oriented much more on profits, on high profits, whereas creditor-oriented accounting information will be much more around the debt level and do not exaggerate profits and so on. Okay, so depending on your target audience of my accounting information, I have different accounting regulations, and that's why we have so many countries in the world, and you have no two countries in the world where the accounting regulation will be identical. Everything is specifically made and adapted to the situation in a country, sorry. That leads over to the next question. Well, should the accounting information be standardized or harmonized? You see, I'm not using the same vocabulary around the world. Okay, standardized or harmonized seems to be rather similar. Well, maybe standardization is a little more stronger than harmonization. Standardization means really that everything is identical and everything looks the same. Whereas harmonization means, okay, everything is similar. So sometimes it's identical, but sometimes there are small differences, but not as much as differences that hinder me to understand or compare the information. So that's a little bit the distinction. And regarding the third question, should accounting information be standardized? Well, we can say yes to a certain extent because, well, obviously I extract information from company A on the financial situation, on the debt level, the profit level, depending on what type of user I am. But this standalone information for one company is rather useless. And it makes only sense, and I can only read it and understand it if I can compare it. I need to compare it with competitor companies, for example. Because I'm a shareholder, that means today I want to make an investment decision. But obviously, as investment possibilities, I have a multitude of other possibilities. And therefore, I need to compare, for example, the profitability of company A with the profitability of company B. And I can only make this comparison if the accounting information is to some extent standardized or harmonized. We can simply understand it. I cannot allow each company to compare its own profit in a way that they want, because then I do not know if the profits in the end are comparable or not. Okay, so therefore, yes, we do need standardization. Okay, in one country, that is the minimum. Should we also have harmonization or standardization around the world? Well, the answer is also yes. Okay, why? Well, because more and more investors obviously have an international orientation. And if I'm a Vietnamese investor and I want to invest money, my only alternatives are not only Vietnamese companies, but also companies in other countries. And therefore, in order to compare Vietnamese companies with other country companies, I need some harmonization, standardization across borders. Okay, therefore, yes, we need this. But that also creates a difficulty if I have worldwide harmonization. Why? Well, because that means today, if I look at an individual country such as Vietnam or France, well, the local accounting regulation, the national accounting regulation, is very much adapted to what's happening in that country, and it's made for the Vietnamese environment, the legal environment, the historical environment, the political environment, and everything. All this impacts the accounting regulation, and the same obviously in France or in any other country. Now, if I have a worldwide harmonized accounting rule book, that is not possible anymore. Because now I need rules that fit to all companies in all countries, and those international rules, they cannot pay attention to national specificities. That's not possible. So that means we will have the international rules are one size fits all, and in this situation, we don't care what the specific rules or legal situation is in Vietnam or in France or in any other country. And that obviously creates a small problem, because now you have a Vietnamese or a French company that wants to use those worldwide accounting standards, but the worldwide accounting standards do not really fit anymore the national environment, and that creates some problems on its own. And sometimes we have to pay attention to this. Okay, that's on the general introduction to accounting. If you have no more questions, we move on. Otherwise, ask your questions in the chat, as I said. Okay, going more to the technical side of the financial reports, in particular for those people who do not have the accounting knowledge. The main part of the financial statements actually is the balance sheet. And in the balance sheet, we see assets on the one hand, on the left side of the balance sheet, and we see liabilities and equity on the right-hand side of the balance sheet. So there's different ways how to interpret assets and liabilities and equity. One interpretation could be in terms of resources. Assets are what the resources of the companies are, and equity and liabilities is who supplied those resources. Have they been provided by creditors, banks, and so on, leading to liabilities, or have they been provided by owners, shareholders, investors of the company, leading to equity? You could also say that assets corresponds to the investments of a company. Okay, the investments that the company did already in the past. Okay, and the right-hand side of the balance sheet, so debt and equity, is how those investments have been financed. Okay, because every euro that the company spend, well, you need some financing, and the financing is either done by shareholders, and we have equity, or the financing has been provided by creditors, and then we have liabilities. Since all investments need financing, that means also that both sides of the balance sheet are always balanced. So the amount of total investments, assets, equals always the amount of total financing, total liabilities, and equity. And this is what we call the balance sheet or accounting equation. Okay, that means investments equals financing, or assets equals equity plus liabilities. Okay, and we have a technique in accounting that allows us to always respect this accounting equation. Okay, so and this technique, as you can see here, is called double entry bookkeeping. And the technique assures that both sides of this equation are always balanced. So technically, it is impossible that my balance sheet is imbalanced. So in a way that I have more assets than the right-hand side or less assets than the financing side of the balance sheet. That is not possible because of this balance sheet equation and double entry bookkeeping. So how does double entry bookkeeping work? So as I said before, the company does its daily business, okay, and leads to many transactions. All right, every transaction is put in my accounting databases, in my accounting system, and it's recorded there in a certain way. And the way is called double entry bookkeeping. And what does that mean? Well, that means each transaction and each amount of each transaction is recorded in my databases, but will appear twice in my databases. Will be recorded in two positions in the balance sheet and or the income statement, as we'll see later. Okay, in a way that the balance sheet remains balanced all the time. Okay, so for example, if my transaction is acquisition of a building for 1 million, financed with a loan, okay, what will change in my balance sheet where I have assets, equity, and liabilities? Basically, well, my assets will increase by 1 million because I have a new asset, an additional asset, the building, and it's valued at 1 million. And on the right-hand side, equity will not change, okay, because here the shareholders do not provide any financing, but the financing comes from bank loan, and therefore liabilities increase because obviously I now have more debt, more liabilities than before this transaction. So assets increase by 1 million and liabilities increase by 1 million. That means both sides of the balance sheet increase for the same amount. And that means before and obviously after this transaction, my balance sheet is and remains balanced. Okay, and this is double entry bookkeeping. One transaction, one amount, okay, but the amount appears twice in two items of the balance sheet in a way that the balance sheet remains balanced. So here, for example, we had a transaction where both sides of the balance sheet increase, okay. I can also have transactions where both sides of the balance sheet decrease, obviously. And I can have transactions that are only on the asset side or only on the equity and liability side. For example, if I buy a building and I pay cash, well, that means one asset will increase, the building asset, but the cash asset will decrease for the same amount, whereas equity and liabilities do not change at all. Either way, it doesn't matter what type of transaction. The only thing I need to make sure is that, after recording for these transactions, my balance sheet is and remains balanced. Okay. So this is all we need to know for this class. Okay, I will not go in the other details because in real life, obviously, our accounting does not look like this. So my accounting system is not composed of assets plus one, liabilities plus one. We need a more sophisticated, a more detailed system. And in the real world, in real companies, the accounting entries or the accounting recordings are made in two supports. One is called the ledger, and the second one is called the journal. And obviously, people who did already accounting before, they know what I'm talking about. So here we do some accounting, but I do not use nor the ledger nor the journal. I don't use either of them. I check directly the impacts in the balance sheet and the income statement. However, people that are familiar with the ledger or the journal obviously are free to use the ledger and the journal. So if when we do exercises or later in the exam, if you are more familiar and more comfortable by using the ledger or the journal, well, feel free to do it. and hand in your answer in the ledger or the journal form. Okay, it doesn't really matter. Those who don't want to do this and those who don't know the ledger or the journal, well, you can do it the way I present it to you. And that means simply pluses and minuses as I did here in the balance sheet or the income statement. All right, so any type of solution is acceptable here. Okay, so far so good. Any question? Question so far? Doesn't seem to be the case, so people are writing. Okay, then let's try to do the first exercise that we have in the case book that is here. Well, let me put this down a little bit. Where am I here? Sorry. Okay, here we are. Okay, here the prerequisite accounting question that we have. So during one accounting period, a retail company carried out the following transactions. And here we have 9 transactions. And what we have to do is we have to account for all these transactions using the T accounts or the journal, or simply by showing the impacts on the financial statements. Okay. And I want you to work on this exercise, please, for the time being, let's say for 15 minutes or so, and then we will do a break, and after the break, we will do the solutions. Okay, so let me show how this works by looking at the first transaction. Not the first one, let's do this together. So creation of the business and contribution from shareholders of an equipment valued at 80 and cash for 120. Okay, so here we're talking about the business that has newly been created. That means we do not have any existing accounting numbers before that. Okay, so here the transaction is the shareholders create the business and they inject, they provide in total 200 to the new company, 80 in the form of an equipment and 120 in form of cash. Okay, so therefore we need to apply our double entry bookkeeping. Okay, and that means, well, we need to check how does this transaction modify the assets of the company or equity or liabilities. Okay, so let's do this. I prepared here an empty balance sheet. Here we go. Okay, so the shareholders provide 80 of equipment and 120 in cash. So how does this transaction modify my balance sheet? So first of all, equipment is an asset, obviously. And therefore, when the shareholders provide me new equipment with a value of 80, my equipment increases by 80. All right. And equipment is a long-term asset. So I put this here in non-current assets. I explain later what that means, but it doesn't matter. Equipment is an asset and that increases. Cash is also an asset and the shareholders provide 120 in cash. Therefore, the cash position of the company, which basically is empty because it's a new company, we just started it, and that's the very first transaction of this company, the cash position also increases by 120. So in total, all the assets increase by 200. The resources of the company increase by 200. Who provided those resources? Do they come from shareholders or do they come from creditors? Well, as we know here, they come from shareholders. And that means basically equity will increase. And how much financing did the shareholders provide? Well, in total, 200, 80 in the form of equipment and 120 in the form of cash. Therefore, equity, or more precisely, shareholders shareholders' capital increases by 200. So that would be the accounting entry for my first transaction. So assets increase by 200, equity increases by 200. Both sides of the balance sheet increase by the same amount. Obviously, my total balance sheet now is 200 on the asset side. My total balance sheet is 200 on the equity and liability side, and therefore we are good. Transaction 1 is finished. That means you can now do the transaction number 2. Basically, purchase of merchandise for resale. And then think about all the other transactions that we have here in number 9. Okay. So I give you 10-15 minutes. After this, we do the break. Okay. And then we discuss solutions. So that means what we also can do is I let you go right now, and we meet again at 8:35. Okay? Do you agree? You understand what you're supposed to do? Yes, you can see my Excel template. There you go. Okay. We meet again at 8:35, and in the meantime, you can do your break and work on the case. And then at 8:35, we will do the solutions to the case. Okay, are you good with that? Okay. Then I see you at 8:45, and we stop the recording as of now. The first case that we were discussing. Okay, so let's continue to work on the case, and we have the second transaction here, which is purchase of merchandise for resale, 80, which are paid later. Okay. So how does this transaction affect our accounting equation? Well, first of all, merchandise for resale means we are buying products. By the way, before I continue, can you hear me and see me? Are we all good? Okay. So merchandise for resale actually would be inventory, because these are articles that are destined to be sold on short notice. So our inventory increases by 80, okay, because we receive those goods. On the other hand, we do not pay immediately. That means we owe money to our suppliers. When we owe money to our suppliers, we recognize a liability in the form of accounts payable. And now we owe 80 more to our suppliers because this is the amount we need to pay. So plus 80 on the asset side, plus 80 in accounts payable. Well, my balance sheet equation or my balance sheet remains balanced. Now we have 280 on both sides of the balance sheet. So we are good. Okay. Again, if you have questions on any of these transactions, please interrupt me or ask it in the chat. The third transaction is advertising expense of 14 to be paid later. Okay, well, to be paid later means we don't pay immediately. That means here also, once again, my accounts payable increase by 14 because that's an additional amount I owe to my suppliers. And why? Because they provide me a service for advertising. So where do I put advertising in my balance sheet? Well, advertising, you know, like a marketing campaign or something like this, is not an asset and cannot be recognized as an asset, because an asset is an item that is controlled by the company, an item that you can sell to somebody else, or that you can rent, or that you can use, or that you can decide not to use, like a machine, for example. Here we have advertising expense, and that does not correspond to the definition of an asset, because obviously you cannot resell your advertising campaign to somebody else. What do we do with this advertising? Actually, we consume a service that has been provided by a supplier. And a consumption is actually an expense and lowers the profit of the company. So here in equity, we can put a line that is profits, you know, or profit, and all profits belong to the shareholders. That means positive profits or negative profits equal losses. So here I have an item, advertising expense, that actually decreases my profit. And therefore, I will put a minus 14 amount in equity. So we have here for this third transaction, minus 14 in profit and plus 14 in liabilities. So my total balance sheet is still 280 on both sides. So everything is balanced. Okay. However, later on, when we have a finished balance sheet, we want to know the total amount of profit, obviously, that the company has generated, as we have said earlier. But we also want to know all the elements that made the profit. So why is the profit plus 8 million? I want to know what are the positive and the negative elements that compose the 8 million. And therefore, in real life, companies will not recognize the minus 14 in profit in the balance sheet, but they would recognize the 14 in a separate statement, the so-called income statement that we see here on the right-hand side. And in the income statement, I will detail all the revenues, so the elements that increase profits, and all the expenses, so the elements that decrease profit, separately. And then later on, we can present the income statement to the shareholders, so, and to creditors, obviously, same thing, so that people can see in detail where the total profit comes from. What are the revenue items? What are the expense items that generate this? So that means instead of putting the minus 14 here in equity, I rather put them in the income statement, where I call this expense advertising. The expense as such is plus 14, but obviously an expense is an item that negatively impacts my profit. So now you see, if I do this and we have no other income statement operation, my total profit would be minus 14, because I have only an expense. And it's only at the very end, when I have a profit or a loss, that I transfer this profit or loss in equity. So it's at the very end that I will put minus 14 here in profit, but in the meantime, I put them in the income statement. But that means the income statement is nothing else than a detailed account of this one line here in equity that is called profit. So it's the same thing as putting minus 14 in profit or putting an expense of 14 in the income statement. It's the same thing. It's just presented differently. No? Okay, so far so good. Then we continue. And again, if you have questions, please interrupt me. No? Transaction number 4, sale of merchandise to customers for 240. And the purchase price of the merchandise that we just sold is 60. So first, sale of merchandise to customers to be paid later, 240. So actually, for sales transactions, we always need 2 accounting entries, not just one. We need one accounting entry for the sales transaction directly, but we need a second accounting entry to record the cost of realizing the sale. Therefore, let's do first the accounting entry for the sales transaction, 240. And I sell those products to my clients, but they do not pay me immediately. They pay me later. Okay, so since clients do not pay me immediately, I don't have any cash movement, but now since I delivered products to my clients, they owe me money. Money that clients owe me is recognized as accounts receivable. So it means based on this transaction, my accounts receivable increase by 240 because now the clients owe me 240 more than before. And where do the 240 come from? Well, they come from the fact that I sell products to my clients, that I have sales. Obviously, sales increase my profit and therefore influence my profit here. But as we have said before using this equity line here or this profit line in equity, I put the positive and negative profit items in the income statement. And therefore, as a counterpart to the accounts receivable here, I will recognize a sales revenue in my income statement for 240. Again, the 240 means I increase my profit by 240. So it's the same thing as putting plus 240 here in equity. So you see that plus 240 on the asset side, plus 240 in equity is balanced. So we are good. But as I said, I don't put the 240 immediately here. I put them only at the very end when my income statement is finished with all the positive and negative items, all revenues and all expenses. Okay, that's the sales revenue. But we see also now that obviously the sales revenue does not correspond to my profit because the sales revenue is the amount I invoice to my client basically, whereas my profit is the difference between what I invoice to my client minus the costs that were necessary to generate the sale. Or in accounting terms, my profit is the revenues with my clients minus the expenses that I had in order to generate this revenue. Okay, and here the exercise tells me that actually I sold products for 240 and this merchandise I sold, I purchased it previously in number 2 for 60. So it means basically in number 2, I bought 80 of merchandise, all right? And in number 4 now, I sell 60 of those 80. And I sell them for the selling price of 240. And then obviously the difference between the purchase price and the selling price, that is the profit of this transaction. So here the purchase price of the items I sold is 60, sorry, which means here I need to take them out of inventory because now the 60 are not there anymore. I gave them to the clients and therefore they are gone. Okay, so minus 60 in inventory. And what happened to those merchandise inventory items? I consume them, I use them. And obviously, when I use inventory, that has a negative impact on my profit. In other words, it's an expense. So here I put as cost of goods sold or cost of sales or inventory expense or whatever you want to call it. Doesn't really matter. I put an expense of 60. Once again, putting an expense of 60 is the same thing as putting a profit of minus 60, because all expenses lower profit. So you see here, I have minus 60 in inventory, minus 60 in equity. Therefore, we are all balanced. Therefore, we are good. But I don't see the 60 immediately. I see them only at the very end. That means also here now in the balance sheet, sorry, in the income statement, I see the profit from this transaction because this transaction generated a sales revenue of 240 for a cost of 60. And that means here my profit or my margin is actually 180. And that's what I see in the income statement. Okay, so for all sales transactions, I need 2 accounting entries, not just 1. Okay. Right. Yeah, I need to come back. Okay. Transaction number 5, salaries for the period are paid immediately, 90. Okay. So that means since I do a payment, my cash position will be reduced by 90. Okay, and what do I pay the 90 for? Well, actually, these are for salaries. So salaries are not an asset. Salaries are not a liability. Why do I pay salaries? Well, because I use the service of my employees. And that means I have here a salary expense. Expenses are consumptions. So here I consume the workforce of my employees, and therefore as a counterpart I pay them a salary, and this is accounted for as an expense for 90. So minus 90 in cash plus 90 in expenses, which would be the same as putting minus 90 in profit. So minus 90, and we see once again it is balanced. Do you have any questions so far? In particular, those people who did not do accounting before that, please. Okay. Not so far. Number 6, miscellaneous business taxes for 40, and they are not paid immediately, they will be paid later. Okay, so first of all, here if I have to pay something but I don't pay immediately, it generates a liability. In our case, a tax payable or tax liability. And the amount of taxes that I owe is 40. And the business taxes, well, taxes are not an asset. Why do I pay taxes to the government? Because the government provides me with services, a legal system, roads, etc., etc. Okay, that means I pay those taxes because I consume a service provided by the government, and therefore I record an expense, business taxes, and the amount is 40. You see here, I do not use the line income tax expense because here we have business taxes. Business taxes are general taxes not related to the profit of the company. Here in the income tax expense, we see only profit-based taxes, and therefore it's called income tax of the company. So I don't use that line. I put in another line higher up in the income statement. Okay, number 7. In number 4, I sold products to my clients. Now they didn't pay at that time, but now later they pay me, and they pay me 130. Okay, which means first of all, my cash position increases by 130, and that's my cash position. At the same time, the claims that I have on my clients decrease by 130, because since they paid now, they owe me much less money. So minus 130 in accounts receivable plus 130 in cash. Well, the right-hand side of the balance sheet is not at all concerned. Therefore, my balance sheet is and remains balanced. Once again, it's balanced all the time. Number 8, I pay some money to my suppliers. When I bought the inventory, I didn't pay my suppliers. Now I pay them 70. Okay, well, since I pay my suppliers, decreases by 70 here. And since I pay my suppliers, that means obviously my liabilities to suppliers also decrease by 70. A bit wider here. Okay. That means minus 70 in cash, minus 70 in liabilities. Obviously, my balance sheet is and remains completely balanced. And the last transaction, the equipment brought in as capital contribution in the beginning is expected to have a useful life of 10 years. Depreciation is based on the straight line method. So depreciation refers to the loss of value that we have for an equipment or any other long-term asset that loses value over time because we use it. And here it says that the equipment can be used over 10 years And the loss of value, the depreciation, is straight line. That means we assume every year has the same loss of value. Okay, so since the original equipment was 80, and I assume that every year we have the same loss of value and I can use the equipment over 10 years, well, the loss of value per year is 8. Okay, that means at the end of the year, the value of the equipment is not 80 anymore, but is lower by 8. Sorry, wrong. Okay, so I need to decrease my equipment value by 8. And what happened to these 8? Well, I received the equipment, then I used it, and because of the use, the value decreases. Well, that means actually I consumed partially the value of my equipment. Consumption equals expense. And that means in my income statement, I will put a depreciation expense. And we calculated the amount already. It's 8. Minus 8 in equipment, minus 8 in profit, because I add depreciation that I have here. Okay, and we are all good and all balanced. Oops, sorry, that's the wrong one. That means we accounted for all the transaction, and now based on this, I can prepare the balance sheet and the final income statement. And then later, we will prepare the cash flow statement. So in order to get to the final balance sheet, the only thing I need to do is, well, calculate the final values of all my items. So we see that the final value of equipment is 72. We see that the final value of accounts receivable is 110. Final value of inventory is 20. And the final value of cash is, well, 30 plus 60 is 90. Okay, so these are the final numbers: equipment, accounts receivable, inventory, and so on. And if I add up all this, we have 292 as total assets at the end of the year. Okay, questions so far? Tell me if that's the case. Final value of shareholder capital is 200, has not changed. The final value of accounts payable here is 24 at the end of the year. Final value of tax payable is whatever it is. But we see that when I add those numbers, obviously I do not get to 292, and that's what I need. Why not? Well, because what is still missing is the profit here. So I need to calculate the profit. The profit is calculated in the income statement. And here I see I have sales revenue of 240, and I have all these expenses that I need to deduct. Okay, I have 150, 190, 200, 212 of expenses. Okay, so total expense is 212. Here I have revenues of 240. Well, my revenues are higher than my expenses, and therefore I have a profit. And the profit is 28. And by putting the profit on this side, well, we see that at the end, well, the income statement is also balanced. Okay, so I put the profit actually here on the left side in order to balance the income statement. But we all agree that revenues are higher than expenses, and therefore, well, there is a profit. And this profit here, okay, is transferred to equity. Right? And we have the same profit of 28 in equity. And now if I add up the liability side, obviously we find 292. And therefore we are good. Okay, so this would be the balance sheet and the income statement that I would put in my financial statements, and that the shareholders or the creditors or whoever is reading the financial statements would see. Okay. Again, let me emphasize the importance of the income statement and the fact that the income statement is not a standalone table that is independent from the balance sheet. The balance sheet is the central document. The income statement is just a detail of one line in the balance sheet. And this is here the profit line. Other than that, profits are part of equity, since all profits belong to shareholders, to the owners of the company. So the purpose of the income statement is not so much to calculate the profit, the 28, I could also get this directly from the balance sheet. The purpose of the income statement is to show me where the profits come from. And I here see that the main source or the unique source of profit of this company is regular sales. Because we have only a sales revenue. We don't have any financial revenue because we speculated on financial markets. We don't have a revenue because we sold buildings or equipment. So we just have revenue that is based on regular purchases, regular products. And I see also in terms of my expenses, so what was necessary to generate the sales revenue. I can see here, for example, that my company is very intensive in labor because salaries is my biggest expense item. So intensive in labor can mean different things. It can mean I have a lot of people working for me, and therefore a lot of people get a lot of salary. Or I don't use many people, but the people that I do use are highly specialized, and therefore I need to pay them high salaries. But either way, my main concern here, or the main cost item in my business here, is salaries, one way or the other. Much more than actually the merchandise that I buy, for example. Okay, that's it for the first case. Any questions, please? And obviously, I will post the solutions on Canvas, so you will get the solutions in Word form. Okay, no questions so far, please. Okay, apparently not. Then let's continue, and let's start with the first part of this lecture after the accounting reminder. Okay, introduction to IFRS, International Financial Reporting Standards. Okay. So we spoke earlier about the fact that it's maybe useful to have some harmonization of accounting rules in the world. And the organization who does this standardization is private, and it's called the IASB. Okay, so we have this here, International Accounting Standards Board. It's a private, actually it's a foundation that is located in the UK. And this organization issues accounting standards, and those accounting standards are currently recognized, adopted, or used by more than 140 countries. Actually, as these accounting standards are issued by a private institution, obviously the IASB has no legal power to enforce their accounting standards anywhere. So what they do is they set up the rules, or they make accounting rules, and then they travel around the world and sell those rules to governments or accounting regulators. Okay, so they go to the European Union, they go to the Vietnamese government, to the Japanese, to all governments, and tries to sell those accounting standards by saying, okay, this is my rule book, and we think it's pretty good for that and that reason, and therefore, how about you use those accounting rules in your country? And then the national accounting regulator, whoever that is, agrees or does not. So today, there are more than, I think now we have 148 countries roughly in the world that use IFRS. Now, when we say use IFRS, you have to be careful a little bit. For example, here you see that Vietnam is listed as a user of IFRS. but that is not 100% true, because not all Vietnamese companies use IFRS. There are some who are doing this, and I see that when I show that to you in the next slide. But adopting countries does not mean everybody in this country uses IFRS everywhere. So there are different degrees. Some countries use completely IFRS and everyone does it. Other countries, as you would see, in particular in the European Union, it's much more diverse than that. And some countries, for example, Australia, they also use IFRS, but actually it's a type of adjusted IFRS. So they take all the IFRSs, but sometimes they don't like a paragraph of the rule or so, and then they just skip it. So they have like Australian IFRS in a sense. Okay, so you have to be careful when you say that, well, this map is from the website of the IASB. Obviously, they want to present themselves in a nice light, but not all 140 countries use that. Okay, however, you see all the biggest economies are in there, except Japan. Okay, they don't use IFRS. However, big Japanese companies use IFRS voluntarily. Okay, so they need to use Japanese accounting rules. You know that accounting rules, usually we call them GAAP, generally accepted accounting principles, and the acronym is spelled out on a later slide. So officially, Japanese companies need to use Japanese GAAP. Okay, but some of them voluntarily prepare IFRS. And the Japanese government is in constant negotiation with the IASB if and when and how they will use one day IFRS. So Japan does not use IFRS officially. And the second big country who doesn't use it actually is the US. Not so much for foreign filers. Okay, so foreign filers are non-American companies that are listed in the US. Those companies can use IFRS. Okay. So for example, European companies, they will use IFRS and they can take the same IFRS financial statements and be listed in New York. But American companies are not allowed to use IFRS. Okay, American companies use US GAAP. Okay, so the accounting regulation of the United States. Okay, so based on this chart, what can we say? Well, there's a clear trend of IFRS. Okay, the major countries in the world do use IFRS, if not on a mandatory way, in a voluntary way, and the trend is clearly of going there. The only exception is and remains the United States. And as of today, it is not likely that IFRS will be made mandatory for US companies in the near future. And why not? Well, because the Americans think that they have an accounting regulation, US GAAP, which is as good as IFRS. And therefore, and they are not completely wrong. So many companies use US GAAP also voluntarily. And therefore, they don't see a need to switch to IFRS. Whereas in other countries, including the European Union, nobody cares about German or French or Italian accounting rules. In the European Union, the story is a little bit different. Here, there is no high quality accounting standards. Therefore, the European Union used IFRS. Okay, that's the general setup. What's the situation in Vietnam? Well, Vietnamese companies use Vietnamese accounting standards, VAS. Okay, some foreign-owned or companies with foreign investors prepare, in addition, IFRS financial statements. So in a sense, some companies already use IFRS. And obviously, Vietnamese accounting standards are issued by the Ministry of Finance in Vietnam. And like all countries, including the ones who don't use IFRS, before you issue a new national rule, you check out what IFRS is doing. And if you like the IFRS rule, you just, copy that in your national system. If you don't like the IFRS rule, well, then you take something else, and we are good. However, in March of 20, the Vietnamese Ministry of Finance has issued a roadmap for IFRS, and as of January 1st, we are in the stage 1. So some companies can now start to voluntarily adopt only IFRS. So compared to this situation here, it means that you don't need to prepare Vietnamese financial statements and IFRS financial statements in parallel. Here, if you opt for IFRS, you have only the IFRS financial statements. So for some state-owned or listed companies, they can do this. In the second stage, so probably starting in 25, IFRS will become mandatory for certain companies. And other companies can use that on a voluntary basis. And then, well, starting in 25, there will be Vietnamese financial reporting standards for those companies that don't use IFRS, but bigger ones. And the Vietnamese accounting standards will continue to be used for very small companies. Indeed, that's one of the problems I issued earlier, that if you have worldwide accounting standards, you cannot adapt to the local profile of business and companies. And also, obviously, if you have worldwide accounting rules, those are made primarily for global companies, because that's the one I want to compare. I don't need to compare, some restaurant shop in Hanoi or Ho Chi Minh with a restaurant here in Paris, and that's not necessary. Okay, but I may wish to compare a listed Vietnamese company with a listed French company, so their IFRS is useful. And therefore, for small companies, or let's put it this way, therefore IFRS is made for bigger companies, listed companies, and is rather complex. And to avoid applying this complexity to very small companies in Vietnam, but also in other countries, there are the national accounting standards that are much easier and much simpler. And for Vietnam, this is VAS, and they will continue to be applied for very small companies, because we don't need, a 300-page financial report for a small restaurant or any other repair shop that you may have somewhere. And therefore, we have a differentiated reporting system. And more information is required by big companies compared to very small companies. Okay. Again, if you have questions, interrupt me or write something in the chat either way. Okay, here's one slide, what the situation is in the European Union. Well, it says 21, but it's still true in 22. No change here. You see, in the European Union, we have similarly to Vietnam, where we have a difference between large companies, listed companies, and other companies. In the European Union, it's similar. We have to make a distinction between listed companies and non-listed companies, and between consolidated financial statements and individual financial statements. So first of all, can somebody tell me what it means, or what do we mean when we say a company is listed? What does listed mean? Can someone tell me that, please? Hello, hello. Anyone there? What does listed mean? Okay, on stock exchange, that its shares will be publicly traded on a stock market. That means here listed, usually when we say listed, it means the shares of the company are listed on the stock exchange, on a stock market. You can also be listed with other financial instruments than shares. What else can be listed? So to give you an example, in France, we have the National Railroad Company, which is called SNCF. And the National Railroad Company is 100% owned by the government. Okay, so no private shareholders, or no shareholders other than the government. However, this company is still a listed company, which means they don't have shares listed, because again, all the shares are in the hands of the government, but something else that is listed. What else can be listed if it's not shares of a company? Any idea? Okay, Dongfang, you tell me commodities. Well, we have commodities that are listed, but what of a company? What commodity? Because if a company owns commodities, like cereal or oil or, whatever, rare metals or whatever, those commodities are assets of the company. Obviously, you can buy and the company can buy and sell those commodities on the stock market, but it does not make the company listed just because you own a listed asset. Here we say that the company is listed, not the asset. Indeed, Tan Hang Wu, bonds can also be listed. So most companies are listed with their shares, okay, but companies can also be listed with liabilities, because a bond is a liability, and bonds as shares can be issued privately to people and investors, but can also be issued via markets, the bond market in this case. And in this case, well, you are listed with shares and bonds, or you're listed with shares or bonds. Obviously, most companies are listed with both. Now, the French railroad company, I told you, is an exception because they're only listed with bonds, but still they are listed in that sense. Okay, so for listed companies, they have to apply IFRS since 2005, but only for their consolidated financial statements, not for their so-called individual or separate financial statements. Therefore, my next question, what are consolidated financial statements? What is the difference between consolidated financial statements and individual or separate financial statements? Has anyone an idea? What are consolidated statements compared to individual ones? No, no idea. Well, someone is writing. Okay, financial statements of the holding company. Yeah, but which one? The consolidated ones or the individual ones? Hier dran. The consolidated ones, well, unfortunately, no. Okay. You are on the right track because you are talking about a holding company. Okay. And what is a holding company? Obviously, a holding company is a company that controls and owns other companies. That means here when we talk about holdings and so on, we are in a situation where we have a group of companies that somehow belong together because the holding company is the head, and then below we have other companies. Okay, so consolidated financial statements are actually financial statements that cover a whole group of companies. And we'll see later what a group of company is. So it means here in a consolidated balance sheet, for example, I see the assets and liabilities not only of the holding company, but of all the companies that are part of the same group. Okay, and these are group or consolidated financial statements, whereas individual or separate financial statements are only the financial statements of one single legal entity. This legal entity can be the holding company. It can also be a subsidiary. If I have one holding company and one subsidiary, there will be two sets of individual financial statements, because I have two legal entities, but there will be only one consolidated balance sheet covering both companies. Okay, so consolidated financial statements apply to groups of companies. And that means, as you can see now, in the European Union, IFRS is mandatory, okay, but only for group financial statements of listed companies, okay? That means not everywhere. Obviously, once again, as I said before, here we talk about the biggest companies, because the biggest companies in the world, in Europe or in Vietnam or elsewhere, they are organized as groups, okay? And that means here the biggest companies in the European Union have to use IFRS, okay? For the other types of financial statements, so for non-listed companies or for individual financial statements, actually the situation depends on each country. So for example, in France, as you can see here, French companies that are not listed, for their consolidated financial statements, they can choose between IFRS or French GAAP, whereas all individual financial statements have to be in French accounting. Okay, so IFRS is not allowed. In the UK, you see British companies have a choice everywhere. They can choose on their own if they want to do this or that. Now, this is obviously the regulation before Brexit, so we have to see how this evolves over time. But as of 22, that's still the case. In Germany, so similarly to France, German companies have a choice here, whereas for the rest, basically, they have to use German accounting standards. And for Italy, last one is also similar, but they have, here you see, IFRS are mandatory even for individual financial statements of listed companies. For the rest, Italian companies have a choice, except, and this may be of interest to you, except in the financial sector. So Italian banks and Italian insurance companies and other financial services providers all need to use IFRS everywhere. Okay, so if they are listed or not listed, it doesn't matter. The financial sector in Italy has to use IFRS everywhere, all the time. Okay, so you see here that, okay, when we say IFRSs are mandatory in the European Union, we are only talking about this field here. In the other area, it depends on the member country. Therefore, you have to be careful. And you cannot just take a Polish financial statement and say it's IFRS. No, you have to check and make sure that's really the case. All right, questions so far? Okay, not yet. All right, here one slide on the organization or the structure of the IFRS Foundation. So the organization that issues the financial reporting standards. And here we have the heart of the organization, the IASB, which has 14 members. And those 14 board members are the ones that vote the accounting standards. Okay. That means all the bodies around this, they are there to prepare and to discuss the decisions. Obviously, an accounting standard, actually within the IASB, usually takes 3 to 4 years between the idea and the first reflections, let's say, and the issuing of the accounting standard. Usually takes 3 to 4 years. That means it's a rather long process. And all those groups here are more or less involved. Sometimes they have a more political role. So we could say that everything up here has a more political role of monitoring the organization. And everything down here has more a technical role. That means here those organizations and bodies, they talk about technical issues of accounting. Okay, where to put things in the balance sheet, how to measure it, and so on. Okay, but the heart are the 14 people here of the board. So you see, there's quite a a structure around this. The main purpose is to get it's a compromise. Compromise between what? Well, on the one hand, here we have an organization that wants to sell It's accounting standards on a worldwide basis, and the easiest way to get acceptance worldwide, internationally, is to involve as many people as possible in the process. Okay, so that's one requirement for acceptance. On the other hand, the more people you involve, the more difficult it will be actually to get a solution. So we see that already at the United Nations. People have, or countries have, a veto right and so on. So it's very difficult to get things done. In accounting, it can even be more difficult because it's very technical, and you cannot compromise. So, you know, something is an asset or it's not. You cannot say as a compromise it's 50% an asset and 50% it's not. Either yes or no. That means compromising is rather difficult. And therefore, in order to have some efficiency, you want to reduce the number of people who actually decide. And here you see the compromise. So we have only 14 people who decide, but we have, and obviously those 14 people cannot represent the whole world. That's not possible. But we have many people in other bodies here around it. And that means other countries that are not represented are also heard. They are part of the process officially, and that hopefully gets to a higher acceptance. And apparently it works so far, because as I said before, we have like 140 countries more or less using IFRS. Obviously, outside of the structure, anyone is free to participate in the debate. So even you and me, you can go to the website of the IASB. You see all the projects that are discussed. Everything is very transparent, it's public. And you can write an opinion on that and say that you don't agree with this measure or that measure and so on. And the opinions of people who discuss this are also published, so you can see who said what, etc. So the process, okay, it takes 3 or 4 years, but the different steps are rather transparent. And the board then has always needs to explain why they made a decision in one way or the other. Now, as you can imagine, many accounting questions are debated in a rather controversial manner. Okay, but it's just for your general education. Don't memorize that, etc. I will not ask you in the exam what is the structure of the IFRS Foundation. So you know the heart is the board. Other bodies gravitate around this, but again, the board is the heart of all this. Okay, now we speak about IFRS, but what do we mean actually when we say IFRS? So therefore, here a slide on the content that is covered, because IFRS actually cover different things. They cover international accounting standards, IAS. They cover international financial reporting standards, well, the literal IFRS, but also SIX and IFRIX, and also a conceptual framework. All this is IFRS. So since we don't want to list all of this all the time, we just say IFRS, and then we mean any of those. And any of those applies in the same way. So there's no hierarchy. So we cannot say that IFRSs are more important than SIX or more important than IAS. Everything needs to be used. Okay, so what's the difference between IAS and IFRS? It's a difference of date, because you see IASs basically are the old standards, the ones that have been issued before 2001. And IFRSs are the new ones since 2001. So in 2001, actually, the IASB was largely restructured, and this is the result of this restructuring and the current structure. Okay, and while they were doing this, they also changed the scope a little bit. So before we had international accounting standards, accounting is a narrower term than financial reporting. Financial reporting is much larger. So in 2001, they also decided from now on not only to cover accounting, but more broadly to cover financial reporting. However, so we could say IAS are the old standards, IFRS are the new ones. That is not completely true. Okay, those IASs does not mean they have been issued before 2001 and never been changed. For example, IAS number 1 is changed literally every year. So it's updated every year. which means that those IASs, although they are old, they will not necessarily disappear over time. IASs disappear only when a new standard is issued, a new IFRS, and new means here completely new, completely changing the accounting. So the IAS said the accounting should be done in way A, but now we decide to change that and make everything in B or in a B way. Then we would issue a new IFRS with the B way, and the old IAS would disappear. But in many cases, we can be pretty sure that they will not disappear. Okay, and if they don't disappear, the IASs will remain on the board. Okay, and IAS number 1 is one of those. That means in the meantime, they're updated. So as you can see today, we still have 25 of the old standards that are still active, although we are already 20 years after the change. And today we are up to IFRS 17. So IFRS 17 is the latest issued on accounting for insurance contracts, for example. IFRS 16, to make another example, is on lease accounting. And this IFRS 16 actually has replaced IAS number 17, who did the old lease accounting way. So here you had one example where an old standard was replaced by something that's completely new. Anyway, both IAS and IFRS needs to be applied. The same is true for the interpretations. So we have the standards as such, but these are standards written in English and applicable all over the world. Now you can imagine that some companies in Vietnam and some companies in Brazil and other companies in Canada, when they read the standard, don't necessarily agree on the interpretation, how to read it, how to understand what the standard is requiring. And therefore, they will go back to the IASB and they will address a question to the interpretation committee. Okay, and the interpretation committee, they will say, okay, here we have an accounting standard and there is a paragraph number 10, and now different companies in different countries read it differently, this paragraph 10. So the interpretation committee will elaborate how to interpret paragraph 10 of this accounting standard. Okay. And then they issue, well, the board actually issues officially an interpretation, and these interpretations are here the SICS and IFRICs. And the same thing, SICS are the old ones, IFRICs are the new ones. Okay, however, the old interpretations will disappear faster, because you can imagine that when I update any accounting standard here, obviously if there was a problem in the formulation, well, in the next update I will deal with the problem, and the problem will disappear. Since the problem disappears, well, the corresponding interpretations obviously also disappear. And that's why there's only 5, 6 still valid, and you see even from the newer interpretations, only 15 are still active, which means 8 of those interpretations have already been incorporated in updates of the standards. Okay, so IAS, IFRS 6, IFRICs, everything has to be used. Okay, but that means also you need to be careful when you talk about all this. For example, it's not the same thing if you talk about IAS number 1 or if you talk about IFRS number 1. As you see, we have both, and they're not dealing at all with the same question. So you have to be precise. Are you talking about IAS number 1 or are you talking about IFRS number 1? Not the same thing. Okay, so we have the standards and the interpretations, but we also have the conceptual framework. Okay, this is also part of the house of IFRS. Okay, which we have basically here at the bottom. And in the next slide, I will give you some more details on the framework. The framework are the general concepts and principles that underlie the financial reporting. So for example, we discussed in the beginning, is the accounting regulation made for shareholders or for creditors? Well, the conceptual framework for IFRS says that primarily here IFRS is focusing on shareholders. Okay, so that's part of the concepts and principles. So these are the foundations of everything. On those foundations, we have the accounting standards, old ones or new ones, okay, either way. And then on the standards, eventually we have interpretations necessary. But obviously, the accounting standards are based on the framework, and all interpretations are also based or should be based on the framework. And therefore, general foundation, standards, and the interpretation. So that's the hierarchy of IFRS in theory, because in practice, we have the so-called overriding principle. What does that mean? That means actually any standard is more important than the framework. So if the framework says you should do A, but the standard says you should do B, well, actually, it's the standard who prevails, and you must do B, even if the B solution is not aligned, is not in line or coherent with the framework. Okay, so it means this pyramid, as it is shown here now, does not really apply, although currently we have very few cases where the standards do not or are not covered by the framework, and we can expect that over time those cases will disappear. But as of now, we still use the overriding principle, and therefore individual standards are more important than the framework. Okay, that's why in practice, as of today, you rarely need the framework. You rarely need to read it. You need to read the standards itself and the interpretations eventually. Questions, please, at that stage. Anyone? You can still hear me, I hope. Hello, hello. Can you still hear me? Give me a sign. Okay, apparently you can. Okay, so let's talk a little bit more about the framework. Okay. Well, in the framework, as I said, we have the objective of financial information, provide information to shareholders, capital providers. Okay, that's what we do here. The information we provide should have two fundamental characteristics. Okay, that means all information must be relevant and must be a faithful representation of the reality. So relevance and faithful representation are very important requirements on anything we do in IFRS accounting. So what does relevance mean? It means IFRS financial statements should only provide information that is relevant for people who read those financial statements. In other words, shareholders. Anything that is not relevant, well, should not be presented. So how do I know that something is relevant or not relevant? Well, relevant information is information that potentially can change the decision of people or can confirm the decision of people. You know, like I decided to buy this share. Now the new information you present me confirms my decision because indeed the company is very profitable, etc., is in very good shape, and so on. Okay. Relevance also means that something that is not important, that is not material, should not be presented. So, for example, you are a billion euro company and you buy a printer that costs 50 euros. Obviously, we all agree knowing that the company bought this printer for 50 euros or not is not at all relevant, is not at all important. So therefore, nobody will ask you to specifically put that, yes, I bought a printer for 15 euros. Nobody cares. So you will not say anything anywhere. It will be in the numbers, obviously, somewhere, but you will not talk about this, no? Because otherwise we would get in what is called the information overload. No? Do you know what the information overload means? Have you ever heard this? in finance or in general? Anyone? Information overload. No? No idea? That means you have so much information that you cannot properly process it anymore. So imagine you have a financial report that makes 5,000 pages with numbers, full of numbers and explanations. Well, you can imagine that will be quite difficult to analyze and to, correctly process all this information. So to avoid information overload, information that is not material should not be presented. By the way, the information overload is a real problem for the IFRS world because every new standards adds requirements of what has to be disclosed and what has to be done. That means companies need to provide more and more information. Therefore, there's currently a project ongoing with the IASB to reduce the number of disclosures, because otherwise one day we will have a financial report that is 2,000 pages and nobody will be able to read this. Well, maybe software, like artificial intelligence, but not people like you and me. Okay, so relevance is very important. And the second fundamental characteristic criterion is faithful representation. Also very important. And what does it mean? That means the accounting information should reflect, that's important, the economic reality of things. It's the economic reality that is important, not any other reality, not, for example, the legal reality of transactions. Okay, so in other words, I sign a contract with the client and legally it says it's a sales contract. Okay, does that mean that I can account for a sales revenue? Well, the answer is no, because first I need to read the contract. I need to see what is the content of the contract. What are the rights and obligations of the two parties signing the contract? And based on this analysis, I conclude that yes, this is indeed a sale economically, and then I will account for sales revenue. Or I conclude it's actually not a sale, but it's a rent or it's something else. I don't know what. In this case, I need to account for something else. Okay, so faithful representation means you need to represent the economic reality, not some other reality, not the legal reality or what else. That means faithful representation. And although it's not mentioned anymore today, sorry, change here. Part of this is a principle. Again, it's not mentioned anymore. It's called substance over form. So this is part of faithful representation. Substance over form, okay, and as I said before, it means the economic situation or substance is more important than the legal or maybe any other form. Okay, substance over form is, well, you could say the concrete result of faithful representation. Okay, so relevance and faithful representation, these are the two items that you need anyway for all information. Then we have some enhancing characteristics. So if you have them, that's a bonus, it's a plus, it's good. If you don't have them, okay, that's a pity, but it doesn't avoid accounting for this as long as the two fundamental characteristics are met. What are those enhancing characteristics? Well, comparability. That means, for example, over time, companies need to use the same accounting options, because you will see that in accounting, there's a certain number of choices. Well, the accounting choices have to be exercised in the same way over time so that we have comparability. Verifiability. you could also say replace that by objectivity. We try to thrive for objective data in accounting. It's not always possible. Okay, well, if it's not possible because it's based on assumptions, it's based on forecasts, and so on, then we try to be as objective as possible. That means, for example, I have a certain set of data. Okay, based on this data, I make a forecast and I get a number. Okay, now I give the same data to you, same information. You do your own forecast, you get a different number. Okay, so all right, because it's a forecast and therefore it's rather subjective. But our two numbers are like in the same area. It's not like you have a positive result and I have a negative result. That would be completely different. Then we have a problem. But verifiability means two people with the same data, they get roughly to the same result. Not identical, but to the same. Okay, so verifiability means objectivity as far as possible. Timeliness means you have to get information out as fast as possible, because the earlier people get the information, the more important it is, obviously. If it's very old information from 10 years ago, nobody cares anymore. And understandability means you should present the information in a way that someone who has a basic knowledge in accounting and in finance will be able to understand the numbers and what you're talking about. Frankly, sometimes that's not the case. So, well, I would suppose that I have some knowledge on accounting, all right, but sometimes you read the financial statements and you have a really hard time to understanding what the company did here, actually. Okay, sometimes there can be contradictions between the fundamental characteristics and the enhancing ones. For example, between relevance and timeliness. Okay, or timeliness and faithful representation. Because as I said, timeliness means you should publish the information as fast as possible. Okay, because then it may be more relevant. On the other hand, the faster you put the information out, the more difficult it will be to have a faithful representation because of the lack of information. So I don't know. Like yesterday, somebody started a takeover attempt on my company. Okay, so obviously you understand it's very important to get out this news very fast, like today or tomorrow. On the other hand, since I learned this only yesterday, okay, what type of details can I give? Well, I don't really know because there's a lack of time. And obviously, it would be better to wait 3 months, and then in 3 months, I would be able to provide more detailed information, better information. But on the other hand, in 3 months, nobody cares anymore about the takeover because, I don't know, it's already over or, it's too late. I don't know. Okay, so there can be conflicts between the characteristics that we have here. And in different situations, well, the solution is not always the same. So sometimes I'm in favor of timeliness, sometimes I'm in favor of faithful representation. It depends. Okay, also in the framework, we have something on the cost constraint. What does it mean? Obviously, remember we have our accounting databases at the beginning. I can do any extraction that you want. I can produce any number, any information that you want in any degree of detail that you want. It's not a problem. It's only a question of cost. How much money am I willing to spend on generating this number or this information? Obviously, I can hire 10 people. I can invest heavily in software. And those 10 people and the software, they will do everything. But am I willing to pay 10 people to get this information? Am I willing to pay the software to get this information? I don't know. Therefore, I will do a benefit cost analysis. Okay. Or more precisely, as it's called, a cost benefit analysis. What does a cost benefit analysis mean? It means, well, I compare the cost of generating an information with the benefit of having this information. Okay. And if cost of generating information is higher than the benefit, okay, don't do it. Right? So nobody forces me to spend a crazy amount of money in my accounting system to generate an information that actually nobody needs, really. Okay, so if the cost of generating an information is higher than the benefits of having it, well, I'm not obliged to do it. This is the cost constraint. And therefore, I made the example before with the printer that I buy for 50 euros. So for example, a printer that you buy for 50 euros, you can use it over 3 years. That means the regular accounting would be, I buy the printer, I put it as an asset in my balance sheet, and I depreciate it over 3 years. Leads to a depreciation expense of 17 euros per year in a multi-billion euro company. Is this really necessary? No. Okay, because the cost of doing this is very high because you need somebody checking this, you need depreciation over 3 years, etc. So that's ridiculous. Okay, so therefore, what will I do? I will buy the printer for 50 euros and I will not put it in the balance sheet. I will put it as an expense directly in the income statement as a loss. Okay, so this obviously is wrong. Okay, but the cost benefit analysis allows me to do this because it simplifies my accounting and therefore I will do it. Okay, that's the cost constraint and the cost benefit analysis that goes with it. Okay, then here we have the going concern assumption. Usually nobody talks about this. It's generally assumed not only in IFRS, but in all accounting systems. And going concern assumption, what does it mean? It means that when I prepare my year-end balance sheet, the income statement, all this, I assume that the company will continue to operate in a normal way. And the company will continue to live for the next foreseeable future, 1 year, 2 years, 3 years. That's the going concern assumption. The opposite would be liquidation. So I could also assume that the company is liquidated. Why do you think that would change the situation? You know, if I set up my balance sheet in a liquidation mode or in a going concern assumption mode, what do you think would be a difference? Would there be a difference? I don't know. Any idea? So liquidation mode means obviously that I think it is likely that the company will not survive and therefore in the near future I need to liquidate it, which means basically stop operating, sell all the assets, reimburse all the people and go home. What do you think that could change compared to a going concern assumption? Well, for example, it would change the value of my assets because in a liquidation you have a machine. Well, in a liquidation you need to quickly sell the machine. In going concern, you can still use the machine over the next 5 years and produce products. Obviously, the value probably is higher for this machine in a going concern world than in a liquidation world. Your accounts receivable, remember claims you have on customers. In a liquidation, many customers will not pay you anymore because they hopefully think they will get out of this without any payment and therefore be good. Whereas, okay, in going concern, they still need to pay you and they can't get out of this. So it's a fundamental assumption. As I said, most of the time going concern is assumed and therefore it's not a problem. It's a little bit more interesting right now in COVID times, because obviously in COVID times, many companies are really badly hurt. And that's why now the going concern assumption becomes much more important. And you have many companies actually where there never talk about the going concern assumption, but in 2020 reports and 2021 reports, as we'll see very soon, they will talk about the going concern, and they will write 2, 3, 4, or 5 pages why they think that even though they are in very bad shape because of the COVID, that they will still they will still continue to operate. And probably also the auditors will write something about this, why they are thinking that the going concern assumption still applies. But other than that, in normal times, nobody talks about this, basically. Okay, so this is the content of the framework, and it also includes some definitions, but most of those definitions are repeated in the individual standards, so we don't need to talk about this anymore. Okay, that means we have the framework as a foundation. We have accounting standards, IAS or IFRSs. We have interpretations. All this is IFRS. All this is the house of IFRS. All this needs to be applied in the same way. Okay. Any questions so far? Up to now, please. Anything in the chat? Not either. Okay. Then I would say I can do the slide and then we are done for the day. Okay, so what is the content of IFRS financial statements? It's regulated in IAS number 1. And the content of IFRS financial statements is similar to what you have in national accounting systems. So it's mandatory to present the balance sheet. We have an income statement. We have a cash flow statement. We have a statement of changes in shareholders' equity, and we have notes. So these elements are typically what you would find in a national GAAP environment. However, there are some IFRS specificities in all those statements, and obviously we will talk about this. Not required by IFRS, on the other hand, is or are management reports, for example, although they are required in many national regulations, and anything as of today of CSR reporting. However, the IFRS Foundation has created the International Sustainability Standards Board, ISSB. So it's a very new creation several months ago. That means in the future, the IFRS world will also talk about CSR reporting. But as of today, no CSR reporting requirement in IFRS. So that means if in a report you see a management report or a CSR report, although everything else is IFRS, those two parts are not IFRS. They will correspond to the national regulation in the country that you have. Okay, then I will answer the question of Dong Fan. IFRS was founded and gradually replaced IFRS. Well, we can say yes. Okay, this is correct. Although the replacement of all IASs may take many, many years, if not decades. Okay, so it's not something that every year some IAS disappear and are replaced. The replacement is very slow, because those IASs are still kept and they are still updated themselves. So there's only a replacement if there's a very fundamental change between the old accounting and the new accounting. If that's not the case, we continue to use IAS. And as I said, IAS number 1, you see it's the one here who defines the content. So I don't really see how you can replace that. So I guess that IAS number 1 will be there for decades and decades, if not forever. It will never be replaced. But other than that, the idea that you wrote down is correct. But again, it will take much time. Okay. Well, if you have no final question, I propose to end the session for today. Any more questions for today? If not, well, then thank you very much. And I talk to you again tomorrow at 7 p.m. I'm still checking the chat if something comes up. Apparently not. Okay. Thank you very much, and bye-bye.